you get a lot of benefits tax-wise for being in the military. BAH, BAS, not non-taxable. So, but you retire, start your second career, start receiving retirement pay. Maybe because you're now going to be more stationary, your spouse can start working. A lot of the retirees are shocked when they see taxes that first full year in retirement of how much they're actually paying. It's good to kind of have a strategy around that. And again, as Mike hit on a couple of times, having that financial plan and just understanding what that's going to look like. So call our example Jack, 05, getting ready to retire in 2 years. Thinks, based on his skill set, probably make about $210,000 in his second career. It's going to get about $85,000 in retirement pay, maybe VA disability, about $20,000. Again, that's not taxable, but it's still income coming in. His wife Jill, she's going to start working, make $30,000. An example, they plan to work till about 64, and then claim Social Security at 70 to max out that benefit. So in the first year of retirement, if they do that starting January 1st, they'll be paying about $96,000 in taxes, in that year, which is a significant amount, maybe multiples of what you paid while you're on active duty, depending if, all you had was active duty income or you had a spouse that worked. So, but it can be quite a shock. So this is kind of their overall tax profile over the next, the rest of their life. So as you can see, there's a big jump 2 years in where they retire and the income goes up, and so do the tax brackets they're in. And then when they retire, because they're not claiming Social Security yet, all they're going to have is the standard retirement pay coming in. And then finally, Social Security kicks in and, their income goes up again. And this is just kind of look at the individual tax brackets that they could be in during those times. So, what do you do? Well, the goal is to pay taxes when they're lower and defer taxes when they're higher. So there are strategies that when you've got that second career going on and your income's, at its highest levels, you want to try to defer taxes. And then in retirement, if you can pay those taxes, when your rates are lower, that can be a good thing, but how do you do that? Well, there's a few tools, and, if you've heard of traditional, either TSP, IRAs, or 401ks, those are pre-tax dollars, meaning if you're making that $210,000 and you're deferring the maximum into your 401k, it's about $23,000. If you're over 50, you get another bump up of about $7,000. So you could be, deferring about $30,000 a year into a 401k. That's money you're not paying taxes on at that highest rate. And then once you retire and your income drops, that can be a great time to, convert that traditional TSP, 401k, IRA over to a Roth account where you pay the taxes, but then they grow tax-free until you take them out of the account. You still don't pay any more taxes on them because you've already done that. And that can be a great thing passing along to kids, or leaving that legacy that you want to, that you've already paid taxes on, but has now grown for another 15, 20 years tax-free, and your kids will still be able to take that money out, and not pay any additional taxes on them. It's a great opportunity. And you've got that window between when you stop working and maybe all you have coming in is your retirement income if you haven't claimed Social Security yet. And then you get the bump up at Social Security. But if you don't do anything and you grow this massive tax-deferred 401k in the traditional side, the government eventually wants its money. For those of us who, have been born after 1960, we're going to have to start taking what they call required minimum distributions at 75. And so at that point, government says you got to take out a percentage each year based on how much longer you're expected to live. So you need to take that and you're going to pay taxes at that point. When with your retirement income and Social Security, you could be in a higher tax bracket. So managing that, again, it's, can be a little complicated. Read up on it, talk to an advisor, but it can be a great way to save a bunch in taxes over your lifetime if you put this in place.